Okay, welcome back, class. Today we're continuing to talk about managerial accounting. And in today's class, we will talk about the different types of costs and how these costs change, how they behave. And this is one of the most important aspects of being able to take managerial decisions to optimize the performance of your organization. So let's start taking a look at these. So here's some classifications, and obviously these are not totally independent of each other. Some costs we will see appear in more than one of these places, and depending on what you're trying to do, the same cost may be listed in one place in one case and in another place in another. So let's start with differential costs or benefits. Now, these are costs or benefits, revenues, expenses in a sense, that change between the different alternatives you're trying to evaluate. So if a cost doesn't change, if it's not differential, then the interesting thing that typically it's not relevant to the decision that you have to make. If something is remaining constant at zero or some other level, whether you take a decision to do this or do this, in that case, it doesn't make a difference. So differential costs are what we're going to be focusing on. And then we have, again, the other group, which are irrelevant costs. These are costs that don't change no matter what you do, and as a result should not be affecting your decision making. Interestingly, human psychology is a little interesting because oftentimes costs or factors which should not be affecting your decision making, the human psychology doesn't do a very good job. Oftentimes, we think that we're rational, maximizing individuals, and everything we do, there's some rationality behind it. But unfortunately, in real life, sometimes that rationality doesn't show through. So we should understand what should be the rational way to act. And when we catch ourselves doing something which is irrational, if we're able to see it, understand it, then perhaps we can prevent ourselves from doing that, or at least reduce the frequency at which we do it. That should allow us to improve our performance. So choose the alternatives where differential benefits exceed differential costs. This is the general rule you should be using anytime you have a choice to make, whether you choose A or B. How do you compare them? Well, A has these additional benefits versus B, but maybe the costs also change in A versus B. So you need to take into account the net effect that that decision will have on you. So that's what we need to pay attention to. And we will also mention opportunity costs. This is if you have a limited amount of a particular resource, an asset. When you make a decision which says that I'm going to be using this asset for this purpose, that also means that you're not going to have that asset available for use in another potential use. And so that the benefit that you would be obtaining by using the asset in the other use, in a sense, is a cost. It's an opportunity cost because you're not going to get that benefit because you have to use it in this thing that you've made your decision about. So opportunity costs are also something we will be taking a quick look at. And then sunk costs. These are expenditures that you have already made and that are not going to change from the new decision that you're going to be taking. So sunk costs are costs that have already been decided about, aren't going to change. So similar to what we've seen above, these should be part of the irrelevant costs. Okay, there may be some irrelevant costs that you're going to have to pay in the future, regardless of your decisions. That would not be a sunk cost, but it would still be irrelevant. So they're not 100% overlapping. And then we have some other things. So controllable, avoidable costs versus discretionary costs. So controllable costs are those that where your decisions can increase or decrease them, right? So in a sense, if you take a decision and you say, I don't want to spend this money, I want to make the decision that keeps this from being spent, then yes, that is an avoidable costs. avoidable costs. And we will see that some cost we think of as fixed costs may actually be discretionary. You may have a choice about them. For example, research and development typically is not proportional to your sales level. Okay, so it doesn't affect this year's sales. Oftentimes, the decision is making, this is how much we're going to spend on research and development this year. And as a result, that is a fixed cost, regardless of how much you produce, how much you sell, that remains fixed. But is it an unavoidable cost? No, it is a conscious decision that needs to be made about how much to spend on that. We could choose to totally get rid of R&D costs all of a sudden, and actually it would not affect the sales of this year. And actually the profits of this year might go up by a huge amount, but you probably would not want to do that. Why? It's going to affect future years. When you don't have a new product come out 2 years, 3 years from now, while all of your competition comes out with a better, new, improved product, all of a sudden you're going to find it very difficult to sell to your existing customers when your competitors are coming out with new, improved versions, and you have to continue selling the old, bad products that you have. So that's another separation. So what kind of problems may you run into when trying to keep track of costs? Well, sometimes it's not very obvious. Okay, so for example, how do I measure the benefit of employee training? We know that employees that have more education, that have been trained in a particular subject, may be able to do a better job, but it's not always easy to measure that in a Turkish lira or in a dollar amount. Or what if they've been trained on etiquette, on how to be nice to people? So they're, nicer employees, they treat their customers better, or they treat the other employees that they work together with better, making the work environment nicer. So this is definitely a plus, but can you actually measure that in an exact cost or as a benefit? Not always easy. Similarly, what is the monetary benefit of a happy customer? Well, the biggest benefit is that happy customers tend to stick around and tend to buy from you again and again and again. But with good data, we might be able to estimate that. But for many companies, we don't have an exact figure of how much value is being added, how much more they're going to be buying from us. But in general, yes, you want to make sure that your customers are happy because, one, it makes them happy. Okay. And two, they probably will help you make more money in the future when they're happy, when they're a satisfied customer. How do I measure the benefit of improved quality? So producing a higher quality product, maybe buying raw material, which is better quality, or using high quality labor, or using machinery, which is more precise. All of these cost money. And let's say that the product that you end up with is of higher quality. How do you benefit from this? Well, you might be able to increase your price. You might be able to sell more. You might be able to lower some costs like for repairs and warranty. But again, it's not always easy to measure all of these, especially at the beginning. Maybe over time, if you keep track of everything, you might be able to see these. But oftentimes, you kind of have to estimate whether it's really going to provide an overall benefit, or are the costs going to be higher? What is the monetary benefit of an improved working environment? Happier employees, working longer and being more efficient. But again, very difficult to put a dollar or Turkish lira amount on this. So these are some potential problems. On the other hand, from benefits to costs, how do I measure the cost of poor quality? Well, part of it is in lost sales. Part of it is having to offer lower prices or having to make repairs and so on. If you can measure these, what is the cost of a dissatisfied customer? Well, you may have to replace the product that you had sold to them, but most importantly, you might lose future sales to that customer. What is the cost of postponing this year's training program? Oftentimes, especially in Turkey, what a lot of companies do is the moment they get into trouble, the moment their profitability, their sales starts to slow down, is they will cut back on training programs. Why? Because they're not exactly sure how much benefit those trainings provide to their customers, because they can't measure it very precisely. But overall, training benefits in the long term. So it's probably not something you want to do, but a lot of Turkish companies resort to this when they need something to cut quickly. They will cut the training and other similar activities. How do I measure the cost of setting my price too high? Lost sales, lost customers, right? So when you set your price at a higher level, if you're still able to sell, okay, you are making additional revenue and probably resulting in higher profits as well. But at the higher prices, as we learned from Economics 101, we know that at higher prices, we tend to sell less. So how much is the reduction in sales? And if I increase my price 10%, if my sales go down 10%, then I won't really have been affected by this. But depending on the elasticity of the demand that you are actually facing, sometimes an increase in price of 10% might lead to a 50% decrease in sales. But in some cases, you increase the price 10% and sales almost don't move at all or go down 1%, in which case your revenue will be increasing and probably your profits as well. So again, looking back at the classification of costs, how may we classify them? Well, one thing we would like to have, and which financial accounting, which we saw before, doesn't always do a very good job with, is classifying the costs according to how they're affected by increases in volume produced and sold. So whether they are variable costs, which increase together with production and sales, or are they fixed costs? They're not affected by how much you produce, how much you sell. This classification actually is very beneficial from a managerial decision-making point of view. And in financial accounting, sometimes we can argue some costs are more like variable, some more like fixed. Unfortunately, for those outside users of accounting information, the classification into cost of goods sold, into operating expenses, into interest expense, and so on, typically doesn't mean that this group is going to be fixed, this group is going to be variable. For example, the one which should be variable, right? Cost of goods sold, embedded in cost of goods sold, actually, we're going to have a bunch of fixed costs which get left in there. Similarly, operating, you might say, well, those should be, fixed, but especially those related to sales, right? Like commissions and so on, probably are definitely going to be variable. But then other costs in there, like rent, like R&D, and so on, they're probably going to remain fixed. So each group has a number of variable and fixed components in them. So what we're going to do in management accounting is try to differentiate those, separate those out, and end up with variable and fixed costs to help us in understanding how the cost changes and how our decisions can be made, what the critical points are, etc. Function related to production or sales. Okay, so depending on this, we can call them product costs or period costs. Product costs are things like direct materials, raw materials, etc., direct labor, the people working directly on the production floor, and a factory overhead, which are indirect. Okay, for example, the heating, the cooling, the management, the cleaning of the factories, these cannot typically be directly associated to a particular product that is being produced there. So we need to find a way to take these costs related to the factory, related to production, but not directly assignable to an individual product being produced. And that's going to be an interesting thing that we need to understand, that we need to be able to do. So traceability, the cost of tracing cost to a cost driver directly So, for example, traceability, if I can tell you that, producing this, if I can determine how much plastic is used in this, how much other materials are used, how much labor is used, then all of those costs are traceable to that particular product. So we want to do as much of this as possible, because those things which are untraceable, we're still going to have to find a way how to assign those to the different things that we've been producing. And that's where it becomes a little less clear about, how it's going to affect your decision making in that organization. And again, with traceability, if you are willing to spend a lot of money, you can trace almost all of the costs with certain assumptions. But again, the benefit you get from being able to trace something oftentimes isn't worth it. You don't get the sufficient benefit. So again, you want to make sure that the costs of being able to trace a particular cost to the units being produced is less than the benefit that you're getting from getting that information. Okay, and then we separate out manufacturing versus non-manufacturing costs. So what we have are non-manufacturing, like marketing and selling costs. So in manufacturing, we're talking about how much does it cost to make this particular product. But after it's made, how much does it cost to sell something is, classified separately. So cost necessary to get the order and deliver the product to the customer are examples of marketing and selling costs. Additionally, administrative costs, the money that you pay your managers across the company. These are non-manufacturing, unless those managers are directly in charge of the production line, in which case, they would become part of the manufacturing cost. But these are administrators working in the rest of the company. And are these significant? Yes, they can be quite large in many companies. So in general, selling, general, and administrative, SG&A, you might see in some financial statements this being referred to as. Okay, so this time the separation into manufacturing versus non-manufacturing versus product versus period costs. So product costs, basically any money that is spent, which becomes part of your inventory of the products that you are trying to sell to your customers, right? So they include things like direct materials, raw materials, hamade, okay, direct labor, the wages that you pay to your employees working on the production line, and manufacturing overhead, okay, things which cannot be directly linked to the actual product, but which are necessary to operate the factory, the manufacturing facilities are put into a manufacturing overhead account. And from there, they are assigned using predetermined overhead rates and so on to the different units being produced. So what ends up with product costs is that they become part of the cost of your inventory. And if you're able to sell them during this period, they go to the income statement where they're recorded as cost of goods sold. And the inventory that is not sold, that remains unsold at the end of the period, stays in the balance sheet as ending inventory. On the other hand, period costs, okay, typically marketing and selling costs, administrative costs, so SG&A. So these directly end up in the income statement, regardless of how much you produce, how much you sell. Okay, so these things for period costs, they are expensed in that particular year. They go directly to the income statement. They do not really spend time on the balance sheet. So the main difference, product costs only become an expense if the goods are sold, whereas period costs are expensed directly in that year. So if we look at the general flow of costs, flow of spending in a manufacturing company, under inventory, typically we will have more than one type of inventory. If you were a merchandising company, you could have just in inventory, or what we call finished goods inventory. In Turkish, goods that you buy ready to sell are referred to as emtia. But in addition to this, typically we have other types of inventory, like raw materials, ham madde. Okay, so under raw materials, you have beginning raw materials inventory from the beginning of the period, what's left over from last year. And then you have additional raw materials that you bought this period. And that is the amount of raw materials available for use in production. This is the maximum that you could have taken out of raw materials and put into the production process. And then it is transferred into an account called work in process. But typically not all of this will be used in production. So as a result, you probably at the end of the year have some ending raw materials in your balance sheet, in your inventory. So if you deduct that, this red calculated amount are the raw materials that were sent into the production process during this period. So in your work in process account, you will have the direct materials transferred from raw materials. In addition to this, you will have a bunch of other things like what? Direct labor, which is, again, the money that you're paying your employees working on the production floor. So direct materials, direct labor, and then manufacturing overhead. So the heating of the factory, the cleaning of the factory and stuff, money that you spend on that, which again is very difficult to trace directly to a direct product, but they are included in an account called manufacturing overhead. And then from that, they are distributed to the things that we produce. So these need to be added to the beginning work in process inventory from the beginning of the year. When you add all of these up together, that is your total manufacturing costs for the period. And from your total manufacturing costs, what we end up having is that some of these will complete their production and will be transferred into your next inventory account, finished goods inventory, but some of them at the end of the period will still remain. So you will keep those as ending work in process inventory at the end of the year. So cost of goods manufactured is what gets transferred out of work in process to the next step, which here we will see. So work in process, the cost of goods manufactured gets transferred into this. So your finished goods inventory, things that are ready to sell to customers. Again, you have a beginning inventory from the previous period. You have the new additions from this year, this period. So plus cost of goods manufactured gives you cost of goods available for sale, right? In the merchandising examples, we had said, beginning inventory plus purchases basically gives you cost of goods available for sale. This is the maximum you could have sold this year if you sold everything you have. But oftentimes you will not be able to sell all of this. And so if you deduct your ending finished goods inventory from this, that gives you your cost of goods sold. So this is how much of your cost of goods manufactured and so on ends up being transferred out of the balance sheet and into the income statement as cost of goods sold. So this is how costs flow through the various accounts, various inventory accounts of a manufacturing company. So again, the cost that you will be spending money to purchase materials. You will be spending money on the employees. You will be spending money on, general manufacturing overhead. And some of the materials, go directly into raw materials, then are transferred into work in process. Direct labor and manufacturing overhead are added also into work in process. And as the production process is completed, it is transferred out of work in process into finished goods. And the finished goods which are sold goes into the income statement as an expense, as cost of goods sold. And whatever is not sold stays in the balance sheet in the ending inventory of finished goods. Whereas selling and administrative costs, which are period costs go directly into the income statement, and they become an expense of the year in which the money was spent. So that's how things move in accounting. Now, how do we approximate these? Well, we need a way to estimate the costs and how they change. So a real cost curve might look something like this. So in the initial beginning phase, you may have, costs even without a lot of production going on, increasing rapidly and then kind of slowing down, and then kind of moving in this kind of manner over here. And then once you hit your capacity, it becomes more difficult and more expensive to start producing again. So over here, you're benefiting from economies of scale. And then after a certain point, the prices start to rise rapidly, and you're hitting the capacity of your store, of your factory, of your facility. And so it starts going up again. So you have, it's assumed, a curvilinear total cost curve, but, and these over different periods, you may approximate these with different kind of cost curves. But we generally simply want to be able to say, well, for our company, this is our fixed cost and this is our variable cost. Well, the thing is, if you can assume that you're operating only in a particular part of this cost curve, then yeah, a linear approximation to these may work. Okay, so if you're only in a particular part of this, typically this is referred to as the relevant range. So if you're producing more than this amount but less than this amount, you're in a range where this linear approximation does a pretty good job of estimating the costs and how they're changing with more output. But if you go outside of the relevant range, you may find that there are big differences between the number you calculate and what happens in reality. So again, if you are making your decisions while in this relevant range, then a linear approximation to this curvilinear cost structure may be appropriate. Just make sure that you're in the relevant range for your organization. And yes, in economics, typically we assume that there is this kind of relationship. There's an inflection point somewhere here, and it's not always easy to pinpoint that. But again, if we say, anywhere from here to approximately here, a linear version of this can be quite useful to what we want to do. So in accounting, for managerial decisions, we will use a linear approximation and say, okay, use this in your decision making. And again, as long as you are, within these ranges, this may be an appropriate tool to use. Okay, so if the main thing we want to do is predict what's going to happen to cost, how quickly or how slowly is it going to increase and so on, then one of the nicest things that we can do is, can our cost be classified into variable and fixed components? So what do we mean by variable and fixed? Okay, so variable costs change when activity changes. So the more you produce and sell, if these costs are increasing at a steady pace, right? So then we say it is variable. The total cost is variable. This portion with output is increasing. Okay, that's the definition of variable. Per unit, we assume it's a fixed amount, but for every additional unit, that increasing amount can be seen, then it is a variable cost. Whereas fixed costs are those that are not affected by the amount that you're producing and selling. So they remain constant even when you are producing and selling different amounts, is what we typically will have. And what sorts of things typically would we have in these groups? For example, labor, direct labor, right? Well, if you want to increase your production, you need to be hiring and using more hours of more employees. So typically labor is the prototypical variable cost, together with direct materials, the metal and other things that you're using in producing your product. If you want to produce 1 unit, you need 1 unit of those raw materials. If you're going to produce 5, you need 5 times as much. If you want to produce 10, you need 10 times as much of that raw material, right? So again, it is a variable cost. But from different points of view, it may be a little different. For example, labor, remember we had said, is a variable cost. But at the same time, what if you have 10 employees and there's a problem, you don't have raw materials or the electricity is cut, and as a result, you are not able to produce anything? Would you still have to pay your employees? Yes, you would. So in that case, interestingly, from the point of view of the entire factory, the labor cost might look like a fixed cost, but from the point of view of the individual product, it is a variable cost. So there may be some definitional disagreements depending on what unit you are looking at. So how do costs change or remain constant across your relevant range? So the variable costs, total variable cost changes as activity level changes. But per unit, typically we assume that variable cost per unit is fixed. That's what we get from that straight line that we're using. 1 more unit produced, the cost goes up by the slope of that cost curve, right? For fixed costs, so these are costs that remain fixed in total. So total fixed cost remains the same even when the activity level changes. This is like the rent of the factory building is fixed, right? But per unit, this is interesting. The more you produce, that fixed cost is divided by a larger amount. So per unit, the fixed cost actually will seem to be falling. So we're referring to the total cost, how it's changing, whether we call something variable, which is variable as you produce more, it is increasing at a steady state, versus fixed, which is remaining constant regardless of how many units you produce and sell. Okay, so another thing that we're going to be interested in is how big or how small are variable costs within the total cost structure. And, you know, if you have a large public utility like electricity production or gas and stuff like this, so they have large investments in factories and in buildings and stuff like that, in infrastructure. So these types of companies will tend to have higher fixed costs, fewer variable costs. They will probably be producing per unit at a lower cost, but they will need big fixed investments to be able to start. A service company, typically, you know, like a restaurant or a legal services or education, they require typically very little fixed expenses. You don't need, you know, a lot of machinery. You don't need, you know, expensive equipment. Typically, what you need is labor, and labors with education, labors with the skills. And so your variable cost will tend to make up the majority of your expenses. So high proportion of variable, low proportion of fixed costs. Whereas a manufacturing company, yes, you will have both fixed and variable costs. Large manufacturing companies like an auto producer, which produces in a huge factory, they will tend to have more fixed costs because of that factory, its depreciation, its rent, and so on, will make up a big proportion of your total expenditures. Yes, a merchandising company usually will have high proportion of variable costs like cost of sales. So if you're a merchandiser, meaning you're not producing, you're buying goods ready to sell, then there's not a lot fixed costs. A lot of your costs is the cost to buy the products that later you sell. So they are basically variable. You need to buy more goods to be able to sell more, and those are considered variable costs. So that's what we end up with having. So what type of variable costs? So merchandising company, cost of goods sold typically is assumed to be a variable cost, right? So I'm buying, these cups, these mugs, these chairs, these tables, which later I am selling. So the cost of goods sold definitely depends on how many I buy, how many I sell. Manufacturing companies, okay, so for them, the variable costs are things like direct materials, direct labor, and within the overhead, a portion of it, the variable overhead, will be variable costs, but there will be some overhead which is fixed, as we will see. Merchandising and manufacturing companies, commissions, shipping costs, clerical costs such as invoicing, all these are dependent on how much you produce, how much you sell, right? So these will typically tend to be variable costs. In service companies, again, also supplies, travel, and clerical costs will be variable. So the more you need to operate the business, the more you will need supplies, cleaning supplies, office supplies, and so on. The more you will have to travel to your customers, you'll be spending on that. And the more secretaries and the more paperwork you will have as your sales go up. So these will be your typical variable costs. On the other hand, your fixed costs will be things like, here we're listing committed, things that you cannot change quickly in the short run. So long-term cannot be significantly reduced in the short term. Things like rent of the factory, depreciation of the equipment, taxes that you're paying on your buildings, on your land. These are fixed costs, which typically cannot be changed, at least not in the short run. But some of your fixed costs may be discretionary. We'd mentioned this before. So like what? Research and development, advertising. For example, could Coca-Cola cut back on its advertising in 2022, the current year? The answer is yes, it's a decision. They could cut their advertising by 50%. And honestly, the effect on this year's sales might not be that big, because advertising builds up over time, the brand image and everything. Even if you cut back on the advertising, the image wouldn't be harmed immediately. But in the long term, it would probably significantly harm the image and the ability of Coca-Cola to sell its own products. Similarly for R&D, research and development. If Intel Corporation decided, I'm going to cut my R&D budget 50% this year, would it have an effect on this year's sales? No, it wouldn't. But the R&D expenditure for this year typically is for the products that they're going to come out with 2 years, 3 years in the future. So it will have a big effect on sales and profitability 2 or 3 years from now. So could you cut back on these? Yes, you could. Should you? Probably not. Once you make the decision, they become a fixed cost. But the discretionary part is that you can take a decision which will reduce that fixed costs for our advertising and research and development, but you might not be able to cut back on the depreciation expense and taxes and equipment, stuff like that, easily. So they're committed fixed costs. And then for most companies that have both variable and fixed costs, almost all of them, the total cost will look like a mixture, right? So it will have a component which is fixed plus a variable component. Or some of your costs might be like this, like phone companies used to have contracts like this. So you'd pay a fixed amount per month and then a secondary amount depending on how much you used it each month. And that would be a kind of mixed cost in your structure. And yes, if this is your fixed and this is your variable, then your total mixed cost could be approximated with a equation like, the total cost is equal to A, the fixed cost, plus B times X, a variable component. If you have over the previous years, if these are your production or sales amounts, and if these are your costs, you may use this data to estimate your cost structure, because you have the different levels of activity over here and the different costs associated to those periods. Then one thing you can do is try to draw a line through these. And sometimes you can get away with simply doing it just by eyeballing it. But if you have statistics programs, or even with an Excel, you can easily use things like OLS, ordinary least squares, to find the line which best fits the data. Okay, so OLS, for example, tries to find the line which has the lowest sum of squares. So the distances, vertical distances from these points to these lines, you take their square and you find the line which minimizes the sum of squares. That is the OLS method. And so here it looks like we have been able to obtain this cost curve, cost line. And so this distance is your estimate of your fixed costs. And then this, the slope of this line, would be your variable cost estimates. Yes, the intercept becomes your fixed cost. And then your slope of the line, as you have, an additional unit of output, how much is the cost affected by this, becomes the slope, becomes the variable cost component. So for that line, what do we have? If your total cost, rises by 1 lira for every 0.8 units that you sell, then you can estimate your fixed cost and your variable cost. And for different units of output, 5 units, 10 units, 10,000 units, you could be able to forecast what's going to happen to your variable and to your total costs. So this slope is your variable cost per unit, and this is your cost equation. Okay, so now we want to get to the point where we can calculate the cost of producing particular costs, or what we refer to as cost objects. These can be anything whose cost you want to be able to calculate. Okay, so anything for which cost data are desired, including products, customers, jobs, organizational subunits, etc. All of these you can calculate costs for if you want to. And you will have direct and indirect costs. So direct costs that can easily and conveniently be traced to a unit of product or other cost object. So raw materials, direct labor are the best examples of direct costs. Whereas indirect costs, again, illuminating the factory. Okay, so how much does a particular table that is produced in that factory, how much of the lighting of the factory has it used up? How much of the electricity, how much of the heating, how much of the cleaning has it used up? These are very difficult to trace directly, so you will include them as manufacturing overhead, and you will use some estimate to assign that manufacturing overhead to all of the different things that you have been producing. So for decision making, this can be quite useful. So again, a decision basically means, do A or do B, or do A or not do A. Again, that's at least 2 alternatives. And the things that you should be taking into consideration, only those costs and benefits that differ between the alternatives are relevant or should be taken into account in your decision making, because if they're not changing, they should have 0 effect on the actual decision themselves. For example, if you've already spent a large amount of money on a project, some people say, hey, we've already spent this much money, so we can't stop now. We need to continue spending. That's wrong. You need to look at things from this point onward. How much more do I have to spend on this project? How much benefit do I expect to get? Just because you spent $1 million on a particular thing, if you need to spend another 1 million and all you're going to get is 0.8 million back, stop. Don't continue to spend anymore if you're going to get back less than the new spending that you have to make. The fact that you've already spent 1 million or 10 million should have no effect on the decision. That is a sunk cost. It should be irrelevant to your decision making. So only those costs and benefits that differ between the alternatives should be taken into account. Yes. So let's say that you currently have a job that pays you 15,000 lira per month and is very close to your house. You have somebody else offer you a job, but it's in another city, right? They're going to pay you more, 20,000 as opposed to 15,000 per month. So 5,000 extra lira. That's a 33% increase in your revenue, in your pay. Sounds great, right? The only problem is because you're going to continue living in the same house, you're going to be spending a lot of time and money driving to and back from your new job in the other city. So if it's going to cost you 3,000 lira per month to drive to and back from that city, then in that case, you need to be careful. Even though the difference in revenue is 5,000, because the difference in costs is 3,000, the net effect is only 2,000. And this also doesn't take into account how much time are you going to be spending on the road, right? So for 2,000 extra lira per month, maybe you're going to have to spend 4 hours extra on the road each week, each day in some cases. So is it worth it? Is what you need to decide. Okay, opportunity costs, potential benefit that is given up when one alternative is selected over another. So let's say that if you were not attending this education, this program, you could be out there working, okay? And let's say that you could find a job earning you 200,000 lira per year. By continuing to be a student, you cannot take that job. So the opportunity cost, or the total cost of this education, isn't not only how much you're paying to the university for this. You should also be taken into account, because you have to be here in class, you can't take that other job, which would be earning you 200,000 per year. So that opportunity cost also should be part of your decision making. What else? Sunk costs, we've mentioned it before. Sunk costs are costs that have already been incurred and you can't get them back. Okay, so these types of costs should be irrelevant, not taken into account. So you bought an automobile that cost 100,000 2 years ago. The 100,000 cost is sunk because whether you drive it, park it, trade it, sell it, you cannot change that cost. And let's assume that you're not going to be able to sell this regardless of what you choose. In that case, that 100,000 cost is sunk. It should not be influencing the decision you're going to be making. Again, psychology of people sometimes makes a problem about this. For example, when let's say you're gambling and you're sitting at a table and you say, hey, right now into the money in the middle of the into the pot. Let's say that you have already bet 100,000, but you look at your hand, your cards, and you say, oh, there's very little likelihood that I can win. You're going to lose. So when the other side increases the bid says, okay, another 100,000. What do? I've already bet 100,000. So do I say, oh, well, from this point on, I don't want to add another 100,000 in there because very, very small likelihood that I can win? Or I already have 100,000 in there. And if I don't bet this, I will be directly losing that. So this is called spending bad money, good money after bad. Okay. The bad money is what you've already spent. You've lost it, but you continue to spend in the hope that you might be able to get that money back, which most of the time never happens. So again, the only costs you should be taking into account are the relevant costs, not the sunk costs, not the irrelevant costs. Okay, and then different types of cost classification for financial reporting. We had been classifying them into cost of goods sold, into operating expenses, R&D, and so on, interest expenses, tax expense, and so on. But that's for financial reporting. If you want to predict cost behavior, this classification isn't always that useful. So in predicting cost behavior for different levels of output, of production, of sales, I would rather have information about my variable and fixed components within those costs. Or if you want to assign costs to particular cost objects, how much does it cost to produce this particular mug? How much does it cost for this advertising campaign? How much does it cost to sell this product online versus in a store? These can all be different cost objects. And then for decision making, what are the relevant costs? What are the irrelevant costs is what you would prefer to have. Now, let's compare typical financial reporting cost presentation versus the contribution format, which classifies those costs into variable versus fixed. So here, this is similar to what you would see in your income statement, right? Sales revenue, net sales probably, minus cost of goods sold, gross profit of 30,000, minus operating expenses of 20, leaves you net operating income of 10,000. So this is what you would see in the income statement. But those same expenses, but classified according to whether they're variable or not, you might see, okay, sales, total sales, still 100,000. That's not going to change. But your variable expenses are 60,000. Most of this will probably come from cost of goods sold. Part of them might be coming from operating expenses, which are variable. So it gives you a contribution margin of 40,000. So this basically 60,000 portion will be when your sales go up, how much do your variable expenses go up? The ratio of this can help you find that. And your contribution margin is for every 100 liras of additional sales, how much after variable costs will I have? This 40% will help me calculate that. And then your fixed expenses, again, most of this from operating expenses, some of it might be from cost of goods sold. So minus your fixed expenses still gives you the same net operating income. But this format will be much more useful for forecasting the costs and the profits at different production and sales levels than this original format. And this is what we're going to be using in managerial decision-making. What else would I have to take into account? Well, what if you have idle time? So a period of time when you're not producing and selling anything. For example, what if the machine has broken down? What if the electricity isn't on? What if you're not able to obtain raw materials? Or, for example, when there was an earthquake in Japan, in Kyoto, LCD screens. They were making most of the LCD screens of the world. So factories all around the world couldn't get LCD screens, so they had to stop production. Or the tires, there was a production problem with tires, which meant that a lot of automobile producers had to stop their production because they couldn't get tires to put onto their vehicles. So these types of events, what do you do with the costs of the employees that are hanging around not working on production? So typically the labor costs incurred during idle time are treated as a type of manufacturing overhead. And you don't, even though it's direct labor, right? You don't assign it to any of the product because nothing is being produced. So you accumulate that into manufacturing overhead, and then you are somehow going to assign them to the different products produced during the rest of the year. Why? Well, it's assumed that a certain amount of breakdowns, power failures, materials shortages are part of business life. And so those costs should be spread out over the rest of the things that are produced in the rest of the productive time that you are using these. How about overtime? Overtime premiums for all factory workers are usually considered to be part of manufacturing overhead. But you might say, hey, you know, this product or this car or this project was completed over the weekend. So there's the regular component plus an overtime component in that cost. So you're telling me that overtime that was used to produce this product isn't added to just this product, it is spread over everything else? Yes. And you know why? Because it was a decision about which one to produce in overtime, which one to produce during regular times. What if the factory manager had said, rather than produce A in overtime on the weekend and B during office hours, what if you had done the opposite? So you would have A produced during regular time and B produced in overtime on the weekend. And all of a sudden, you have that cost being shifted from one to the other. So in that case, because it is a simply managerial decision which determines which one is during the day, which one is overtime, any overtime should be spread out over all of the products, unless there is a special rush order which you receive, which you know that you're not going to be able to produce during regular hours. If that one has to be produced during overtime because it is what caused the overtime, then for these types of productions, yes, you would want to include the cost in the cost of that particular product. But you have to be careful about this. If it's just, you know, a regular order, which, you know, we weren't able to produce during regular hours, you should not be punishing that particular product. Which brings us to our unit costs. So this is, you know, how much is that product actually costing us? So what's included in this? Direct materials. So actual usage of materials, or by the engineering estimates, according to, so for this mug, we will use this much wood, this much metal, this much paint, this much materials on a standard cases, because you could actually measure for every single cup being produced, but it would probably cost too much. An estimate might be more than enough to do a good job in estimating the direct materials per unit. Direct labor, again, determined as actual usage of materials, or again, by estimates, according to your standard costs. And then manufacturing overhead, the common production costs that you assign to each individual unit. And then we will show how traditionally manufacturing overhead had been assigned. And typically, overhead was assigned according to direct labor hours used in the production. Why? Because in the old factories, manufacturing overhead had been also caused by employees working, because the overhead were like managers keeping track of the employees, or the biggest cost component were the employees working on the production floor. So they basically determined all of the other costs as well. But in today's factories, especially with automation and new technologies, direct labor hours may not be linked to what's actually driving the costs. And so we're going to show how ABC, or activity-based costing, may provide much better estimates of the unit costs of production. But typically, we will say unit costs are made up of direct materials, direct labor, plus manufacturing overhead per unit assigned to that particular production. What else do I need to think about? Well, fringe benefits. These are other payments made to my employees other than their direct salaries. So insurance, retirement, unemployment, Medicare, Social Security, workers' compensation, if they have an accident and stuff like this. All of these also need to go into your calculation. So it's not directly how much money am I putting into the pocket of my employees, but all of these other benefits also need to be taken into account in determining the unit costs. Some companies, yes, include all of these costs in manufacturing overhead. But some of them will estimate this and then divide it between the labor hours and add it on top of the direct labor cost. So how are we going to allocate the indirect costs to manufacturing overhead? And then from manufacturing overhead, how will I assign these to the different products? Okay, so traditionally, direct labor hours, or DLH, had been used in order to determine how much of the overhead to assign to a particular unit. But automation, computer technology means that now we have a lot of machinery, equipment, and their depreciation makes up huge amounts of the manufacturing overhead. And if I have totally automated the process, let's say I have two production lines, one which still uses a lot of labor, not as much machinery. So direct labor hours are high there, but another production line which is totally automated using a lot of fancy robotics and stuff like this, and is very efficient, produces a lot of products every day. And the amount of overhead from the first production line. So I have a few managers keeping track of the employees and helping them out and, looking after them. But their cost in overhead is relatively small. The biggest chunk of the overhead comes from the depreciation of the fancy equipment I'm using in the automated production line. But if I were to assign that overhead based on how many direct labor hours are used, most of that overhead would be assigned to production line 1, which uses employees still, versus very little of the cost that is created by these machines would be allocated to production line 2, where almost everything is automated. So that could be a problem with traditional costing. Activity-based costing, so procedure that attempts to provide a more precise allocation of these indirect costs by estimating what's causing them and then using different cost drivers to assign the different pools of costs. So here's a sample company, produces 400 units of A, 20,000 units of B each year. Direct materials for the different products, 10 lira for product A, 15 lira for product B. Total indirect product costs, 900,000, and direct labor hours, 50,000. Okay, so product A requires, to produce the 4,000 units, each of them requires 2.5 direct labor hours, whereas product B, 20,000 units of them, each unit requires 2 direct labor hours to produce. So this is pretty close between the two. Direct labor costs 30 per hour, 30 TL per hour. Cheap, right? So let's determine what goes on. So we're also told that the 900,000 indirect costs, so this 900,000 indirect cost actually is made up of 255 for machine setups, for making adjustments to the machines being used in production, quality inspections, 160, production orders, how many units need to be produced, how many batches, 81,000. Machine hours worked, 314,000. And then material receipts, when you receive raw material or spare parts, you need to record these, you need to put them in inventory and so on, and 90,000 from that. Altogether, 900,000. Okay, so how would we assign this 900,000 to the different units that are being produced? Let's take a closer look at this. So if traditionally, they use direct labor hours to assign all of the costs. So first they need to determine manufacturing overhead per unit. And to do this, they use predetermined overhead rate, PDOR, which is equal to the total overhead that you expect to have divided by direct labor hours. So we're going to see we had, 900,000 total overhead expectations, and divide that by the number of hours, direct labor hours that you expect to have. So we had the 2.5 hours for A, 2 hours for B, and 40,000 units of this, 2,000 units of the other. So how many direct labor hours do you expect to have this year? Do that calculation. So that gives you this rate to use to assign the 900,000 to the various units being produced. So manufacturing overhead per unit, you take the PDOR, predetermined overhead rate, and you multiply it by the direct labor cost per hour. And then adding in the other direct costs, direct materials, direct labor, and the manufacturing overhead per unit, that would give you your unit cost. So it looks like this. Total overhead, 900,000. We expect to produce a certain number of A and a certain number of B, 2.5 hours to 2 hours. So the total direct labor hours that we expect to use for this total production is 50,000 hours, which means that 900,000 divided by 50,000 for every labor hour, which was going to cost 30 liras. I add on 18 liras, and that would help me assign this 900,000 component to the different units produced as well. So manufacturing overhead per unit of A, at 2.5 direct labor hours, we're going to have 45 liras per unit added on of manufacturing overhead. And for 2 hours, direct labor hours used per unit of B, 36 manufacturing overhead is going to be assigned per unit produced of B. So using this information, we also have direct materials, 10, 15, direct labor, 75, 60. This is the 2.5 hours times 30, 2 hours times 30. This is how much you're paying for the direct labor hours, plus the manufacturing overhead applied to them, 45 and 36. So if we add up the total unit cost, we find that it costs us about 130 lira to produce 1 unit of product A, and it costs us 111 to produce 1 unit of product B. And let's assume that our company has this pricing approach, which says, well, to determine the price, we take the unit cost and we add 25% or 50%. It depends on, your company's approach. This is called cost plus pricing. It's not a very good approach, but it's the most frequently used one in business. So they take the cost and they say, okay, I want this much profit margin on top of that, so I'll sell at this price. A better approach would be to determine how much benefits the users get out of it and try to set the price closer to that rather than to cost. But that's not always easy to find. This is more easy to find typically. So 130, if we add, let's say, about 25% to that, let's add about 40 to 50 lira on top of that. So we might sell this at a price of between 170, 175, let's say, versus product B. Again, adding about 25% on top of that, that would be 30, 35. So we're selling this for about, 100, let's say 150 lira, we're selling this, and this we're selling for, let's say, 175 with the new prices. And we want nice round prices. Or if you want, I don't know, add more. Sell this for 200, sell this for 150. Yeah, it depends on you. But this is a type of pricing you might do if this is all the information you have about unit costs. But somebody comes to you and says, hey, you know, a lot of our overhead actually was coming from a different part of the business, from something not that related to the direct labor hours. And if we use this new thing I've heard of activity-based costing, ABC, let's try to redo these calculations. So going back and looking at how much machine setups each product needs, 5 to 3,000. Three total of the total 5, 60% for A, 40% for B. For quality inspections, of the 5,000, of the 8,000, 5,000 for A, 3,000 for B. Of the production orders, so of the 600, 200 for A, 400 for B. Wow. So for example, for production orders, twice as many production orders for B. So maybe the unit order size for B is much smaller. So a lot of the cost for that should be going to B, but we were assigning it 2.5 to 2 hours based on labor hours. So this might be a big difference. Machine hours worked. We actually have a lot of A being produced, but machine hours, only 12,000 and 28,000 for B. Wow, this is another big difference because we were assigning the overhead about 2.5 to 2. Whereas for machine hours, product B is using much more machine hours compared to product A. And then for material receipts, again, product A, only 150 of the 750 versus 600 of the 750 to product B. So using this information, if we try to calculate the ABC unit cost, what we need to do is find the appropriate assignment for each of the separate types of costs. So for example, for machine setups, which had a total cost of 255,000, a total of 5,000 machine setups are done. So for each setup, 51 lira gets appointed, so that the 5,000 total setups at 51 will assign all this to 55,000. Similarly, for quality inspections, if 8,000 quality inspections are carried out, then each of them costs us 20 lira. Production hours, 81,000, 600 of them done, 135 per production order, 785 per machine hour worked, 120 per material receipts. So using this new information to assign these costs, what is our manufacturing overhead allocation going to look like? So the machine setups, so we had this ABC rate of 51 lira per machine setup. For product A, we had 3,000 setups. So of the 255,000, 153 goes to A. So for quality inspections, 20 lira per inspection, a total of 5,000 inspections carried out for product A means that 100,000 lira goes to A. So for production orders, machine hours, material receipts, all of the same calculations are done, and we end up with 392,200 out of the 900,000 is allocated to product A. And if we divide that by how many units we expect to produce, 4,000, that means that we should have manufacturing overhead of 98 lira per unit produced of A. If we do the same thing for B, we end up with 25 lira overhead per unit produced. So total indirect costs of the 900,000, 507,800, more than 50% goes to this, but when divided by the 20,000 units, 25 lira each. So that means that the total 900,000 has been assigned to A and B, and then divided by the units and so on. But the cost, the total cost becomes direct material, direct labor does not change. They're the same whether you use ABC or traditional. So the 10 and 75 and the 15 and the 60 aren't changing. What's changing is this manufacturing overhead. Right now we have 98 lira assigned to product A per unit of A and 25 assigned to unit of product B. So the total unit cost comes out to be 183 versus 100. Wow. If you notice, this is pretty different than what we had before. And here's the comparison of the two. Traditional costing had told us it cost 130 to produce A, 111 to produce product B. And with the markets, we had said, well, let's sell product A for about 175, I think, and product B for about 140, 150. And when we actually are selling at those prices, so we probably would encounter something very interesting, that for product A at a price of 175, wow, we have a lot of customers coming in and saying, hey, that's a great price. Let me buy as much of this as possible from you. This is real good. But for product B that you're trying to sell for 150, a lot of your competitors were much more competitive than you, and you weren't able to sell many of product B. You were very easily selling A, but had difficulty selling B when you used a simple markup on top of the traditional costs. And the reason for that is that it is actually costing you 183 to make 1 unit of A. And you were selling this at a loss, while your product B actually was cheaper to produce than you had thought. And the price that you were charging for this at 150 was much too high. And your competition was eating you alive there because they were charging only, 120, 130, and were attracting all the customers. And you know what's even worse? Because the cost of this, the real cost of this, is so much higher, you would probably end up with much lower profits than you were hoping for, because you're going to be focusing more on product A, you're going to produce and sell more of A, but your costs are going to be much higher than you had thought, and you will be selling less of product B. So you're thinking that, oh, my costs are going to go down a lot, but it's going to go down less than you think due to that. And your profit margins are going to be much less than the 25% you were hoping for. Why? Because you misestimated the unit costs, and that ended up in your selling prices, and it ended up being a pretty bad managerial decision. So when does using ABC make the most sense? When if you're only producing a single product, don't worry about using ABC, because all you need to do to assign the direct materials, direct labor, and manufacturing overhead is keep track of all the costs, divide by how many units you produced, and you'll get the same number whether you use ABC or traditional costing. You don't need to do anything fancy. You need to use ABC when you have a number of different products and services that you're producing and selling, and especially if the technology or the approaches that you're using in producing these are significantly different. For example, one uses a lot of manual labor, the other uses an automated system, everything is done by hand, the other uses high technology, and so on. So this can create a lot of problems. And also, if your manufacturing overhead is very small compared to your total cost, again, it doesn't make a lot of sense to this. So products and services that use indirect activities in different ways, like direct labor hour or machinery hours and so on, that have high percentage of indirect product costs. So in these cases, yes, using ABC may be beneficial. Problems? Well, determining and keeping track of the cost drivers, what is causing the cost to go up and down, may be difficult, to find. They may be difficult to measure. ABC ignores difference between fixed and variable costs of an activity. It simply does the assignment. It doesn't really say, oh, this much is fixed, this much is variable. And ABC is going to cost you money to set up a system and to keep track of these different pools of costs and cost drivers, etc. So you want to use this when the indirect costs are high and when it's going to make a big difference when you use this approach to determine the unit costs. And then we come to quality control and the costs of this. For our purposes, I'm going to give you these slides and I'm going to give you some resources to look into, but I will be skipping over this part of the presentation for this semester. So I hope you have enjoyed learning more about cost classifications and cost behavior. And please use this and be ready for the questions on the exams. I will also be providing you some sample questions, so be on the look onto the website for those. Have a good day.